Should you put more or less down on a mortgage? A popular question I get from homebuyers is deciding how much to put down on a new home. And to add some clarity, imagine you're trying to negotiate to buy a house for $500,000. The down or down payment is the amount of money you will put up towards that home purchase. The remainder is the amount of the loan you're going to get from your lender. Each loan program has a minimum down payment amount, which is a percentage of the home price. Conventional could be as low as 3%. The FHA has a 3.5% down payment minimum, and the VA has no down payment requirements. But these are just the minimums. Now, I'm not going to get into other down payment assistance programs, but there are many ways to skin a cat in this day and age. But on the surface, you may think, hey, if I have the cash, then put more money down, right? Lower the amount of the loan and lower your payment. Well, not so fast. The subject can be a little tricky. So in this video, we're going to dive into the concepts of preserving your cash, managing your payment, especially in a declining interest rate environment, and planning for the potential for a refinance in the near future. So the big question is, why preserve your cash? Preserving your cash in a mortgage scenario would simply be putting less money down on a house and financing a larger loan. And here's some great reasons to keep money in the bank instead of throwing it into the mortgage. First off is liquidity. Putting a large sum down now locks your money into the mortgage, and the only way to access it later is to borrow it. So if you think about it, that money is really doing nothing more than reducing the interest payments on the loan. It's not growing. That equity doesn't get any bigger just because you put money down. Another good reason to preserve your cash would be the uncertainty with interest rates. I know that sounds weird, but with interest rates expected to change in the next 6 to 9 months, holding onto your cash gives you flexibility when it's time to refinance. Cash is king. And if we don't see rates go down as much or at all, having cash on hand is going to be your best friend. I mean, think about it. If the payment's higher, wouldn't you rather have a little bit of cash? Another reason to preserve your cash is it really leads to more strategic budgeting. By keeping your down payment low initially, you can better assess your financial situation, and it allows for more of an informed decision on even whether to infuse the additional cash or not. A lot of situations, there is what's called a recast. Lenders don't like saying that these things exist because it does vary from servicer to servicer, and on some programs, it's not even available. But recasting is when you dump a portion of your principal down and it will actually lower your mortgage payment. You don't have to refinance or do anything. So there is a way to do that on certain loan programs. I did do a video on recasting. You can see the link in the description here, and it'll kind of take you through a spreadsheet I did and calculating all that. I hope that's helpful. But the idea is that if refinancing becomes an option, you're going to have the cash to put the right amount of principal down to curtail it to your desired payment. Because if you toss the money in too early, you lose that choice. Another reason may be future purchases. I've talked to so many homebuyers that wish they would have held on to the cash. Maybe they got in a little bit of trouble. Maybe they had some things they wanted to do to the house. And I can just say, many homebuyers have been in the position of wishing they had had a little extra cash on hand to fix some things around the house or purchase some much needed items. I can't tell you how many times people come to me after they've put down a large down payment and said, hey, Rick, can I get a home equity line of credit? By the way, home equity lines of credit are great. We do offer them, but they're at a higher interest rate than you would have gotten on your first mortgage. So all these things need to kind of fit into the decision making when you're deciding on a down payment. Now, the counter argument here is to put a large payment down to reduce the mortgage payment and the interest over the life of your loan. There are some downsides that may not outweigh the loss of liquidity. So first is keeping your payment slightly on the uncomfortable side could be a smart move. And as explained earlier, it just could ensure you have a little bit more cash reserves for future opportunities or emergencies. Additionally, the money that you're throwing into the principal of your home has zero value. I touched on this earlier, and it actually lowers your return on investment. Think about it. The home is going to appreciate in value whether you put $100,000 down or zero down. The down payment monies have no value and do not grow. Another overlooked downside is that the money you put down should have value. Would the money do better in an investment portfolio? And I keep coming back to this, but could the cash save you from future borrowing at a higher interest rate. In other words, Rick, I need a line of credit. So just consider all this. If you have questions about how much money you should put down, I've created a really nice spreadsheet that you can use to plug and play these numbers to your heart's content. Just click the link in the description and download my free homebuyer spreadsheet. And of course, I'm always available to answer any questions in the comments. You can also schedule a call. Take me up on it. Oh, and don't forget to like, subscribe, and hit the notification bell for more insights and mortgage strategies and, of course, market trends. This is Rick, and I'll see you on the next one.